Hi, everybody. Welcome back to Dividend Stockpile. Today, we're joined by David Sherman, CIO of CrossingBridge Advisors. And we're going to talk about navigating markets at all-time highs using low beta, low duration fixed income strategies. We'll cover why return of capital is more important than return on capital. We'll talk about how some short duration events can disrupt long-term income flow. And we'll talk about how to balance risk without sacrificing income. So with that, David, it's a pleasure. Welcome to the channel.
Hey, Jeremy, it's great to be here. And basically, what you're saying is don't lose money is the first rule of investing, and then figure out how to make it no matter what.
Being an income investing channel, we are focused on anything income related. So we talk about stocks, we talk about ETFs, we talk about bond funds, individual bonds, option-based ETFs. We kind of cover it all. But a lot of what we talk about is on the equity side of things. And what I know your company, CrossingBridge Advisors, mostly focus on strategy-wise is more of the fixed income, shorter duration, more quote-unquote safe or relatively safe products. So I wanted to have you come on and talk about kind of the nuances between equity investing, especially when the market is at all-time high, and preserving capital and growing your capital and still getting that income. So with all that said, can you give a little bit of background on yourself and a little bit about your company maybe?
Sure. Very simply, CrossingBridge Advisors is a $4 billion money management firm focused on mutual funds, ETFs, and UCITS in the ultra short duration category, meaning a maturity of 1 year or less, high income, low duration strategy, which is sort of 3 years or less maturity, primarily in corporate bonds, and then strategic income, which is sort of trying to produce income streams in corporate bonds, generally with lower duration, as opposed to the ag, which is mortgages or long-term bonds, with some total return components where we're willing to take some volatility and risk to get a little bit more return. So it's almost like a hybrid between equity and traditional debt.
As I mentioned before, a lot of people focus on the long-term equity side of things for the income generation through dividend stocks and dividend funds and things like that. But sometimes you don't have to take that long-term risk to get similar income. A lot of these short-term income strategies are still paying 4, 5, 6, even 7% on a relatively safe basis on the low duration, as you mentioned. So for a lot of investors, they might not be needing to take the risk that they're taking in the equity markets when they have fixed income or low duration products that could provide the same level of income if that's what they're looking for. And so that's what I really found interesting about your work and your company is that you guys do focus on that short term, but still do provide that higher income that a lot of investors are looking for.
So for instance, I'll give you two examples quickly just to make the picture a little clearer. So a stock that I think is income oriented, meaning it's a stock, it pays a very big dividend, so it's generating a ton of income. But yet, if the company grows, you get the benefits, and if the company doesn't do well, you get the failures. So there's a stock called Flex LNG. The symbol is FLNG. For full disclosure, we do have this equity position in some of our funds and strategies. So what's interesting about this company is today, as I see here today, it's trading, I'll call it at 25 and a quarter, which according to Bloomberg is an estimated 13.7 times earnings for a company that moves liquefied natural gas, LNG, and transports it, and it creates also some LNG through their ships. So clearly that's an alternative energy of gas that's where there's a bottleneck right now in actually processing, right? There's a huge need for the long-term contracts. And the company is significantly owned by a guy named Fredrickson, who's a well-known Nordic shipping successful person. And what's interesting about this is, okay, well, it pays an 11.82% indicated dividend yield according to Bloomberg. Now that's a crazy yield in today's environment, right? I mean, think about where treasuries are. That's I mean, let's just go look today, right? If we go look at the treasury today, you've got a 10-year US Treasury bond, yielding 4.2%. That's a huge return over a 10-year bond. So you can say, well, is it an equity? Is it a bond? Well, here it's both. It's an equity that pays a very large dividend. That large dividend means they're not reinvesting as much of their money back into the business. That may or may not limit the growth prospects, but at the multiple earnings, doesn't seem like a problem. So clearly there's something wrong here. So if I was teaching in my NYU global value investing class, that we teach external MBAs in the fall, we'd say, look, something's really crazy. When you have a stock with a
Hmm.
big dividend, it
Hmm.
means one of two things typically. Either the stock price is going down because they've got to cut the dividend because it's not sustainable, or the stock price is going up to arbitrage the spread differential between current what you can earn in on treasuries and that spread.
Yep.
So clearly, we think because we own some of this that the 11.82% indicated yield is too high, right? Or we think that if they cut the dividend, the stock's not going to go down by enough relative to the price we're getting. So it's like a bond, except
Mm.
you have unlimited upside and you have limited downside. Now, in this particular company, they don't have any publicly traded bonds.
Okay.
Okay. But a peer of theirs, a competitor, a company called Golar, GLNG, also has a stock that pays a small dividend. They have a stock, GLNG, that's trading at call it 40.7. It's trading at 28 times estimated
Mm.
earnings and pays an indicative yield of 2.46%, according to Bloomberg. So clearly, people view this based on the PE and the dividend yield that they're taking some of their money and reinvesting and getting higher growth rates.
Yeah.
Again, that's a typical stock you do, but they do have bonds. And so, for instance, you can go out and buy the Golar 7.75% bonds to 2029 at around par, meaning 100, which
Hmm.
means you can lock in a 7.5% return on that company, assuming that the bonds pay off at maturity, that they're money good, they pay all their interest and they pay all their debt.
Yeah.
Or you can buy the stock. So here's a great example of where maybe instead of buying a stock with this high PE at Golar and betting or hoping the company can execute their strategy to to support that large PE. Remember, it's still a capital intensive business.
Hmm.
It's still shipping around stock. But you could say I don't want to have a view on if it's overvalued or undervalued or it's going to go up or down on total return. I think that the company I think that the company's debt, their $1 billion of debt, is more than the total value of the business, no problem. So I'd like to go buy a 2029 maturity it's in September, so it's basically in 4 years.
Hmm.
And I can lock in at 4 years if I think it's money good, a 7.5% yield. And maybe there's an event that takes it out early. They take the bond, they call the
Hmm.
bonds, or the company gets taken over where there's a change of control provision at 101, right? That means you're going to pick up a little bit of capital appreciation and you're not taking that volatility risk in the stock. So,
Yeah.
that's one we're looking at. What's sort of interesting in there is you can say, well, do I think gold, if I'm looking at LNG as a space, do I think Golar's bonds are more interesting than FLNG stock? But
Hmm.
there's an example of how you can think about bonds and stocks in high dividend income scenarios to try to do it. It's important to remember debt has you can lose all your money, but you have limited upside. So
Hmm.
you want to be certain that because you're higher in the capital structure, you get paid out before the shareholders in a liquidation. You want to make sure um, that you understand that you could have downside, but you're limiting your upside. So that's sort of the distinguishment between, I'd say, dividend stocks and fixed income when you start thinking about them. I hope that was providing
Yeah.
some clarity.
Definitely. And it's you have to look at yourself as an investor and see, what kind of risk tolerance you have or what kind of risk capacity you have. Because if you are approaching your time where you're going to be using the income, are you willing to take that risk of an equity having a 50% drawdown or whatever? There's a lot of things that could happen on an equity, whereas opposed to a bond is more of a sure thing, and you know what you're going to get, generally speaking, when it comes to locking in, especially on a high quality investment. So really, I think it does come down to the investor's risk tolerance and risk capacity and their timeline.
It's 100% about what are their needs
Hmm.
and what are their risk tolerances.
Yeah.
By the way, just for full disclosure, both in Golar and Flex LNG, we have and may today have positions in both the debt or the equity. So I just want to be clear.
Yeah.
So we're very familiar with both companies. But in that regard, where it's what's your risk tolerance, a lot of people try to balance their portfolio out in the old days, what they call 60-40.
Hmm.
Right? I'm going to own some fixed income. I'm going to own some equity. The fixed income will generate a stream of cash flow to support me either my lifestyle or needs, and the equities to grow. Well, that didn't work out in 22, right? Stocks went down, bonds went down
Hmm.
because they're looking at a long-term bond portfolio,
Yeah.
right? And partly because typically short-term rates are lower than long-term rates.
Yeah.
That's not necessarily true in the last several years, but That's tradition. But I think there's another way people should look at it. So uh, let's take you for example. Your oldest is what, 16 or 17,
Yep.
right? So you've got a whole bunch of money in the college fund saved for them, but then you're
Yep.
going to need some supplemental income probably because you have a lot of kids, so it's all fungible. And um, so in 2 or 3 years, you have a college bill you're going to be paying, I would
Yep.
think, or some
Yep.
type of further education bill. So do you really want to keep the money you've got invested in income-oriented equities, dividend
hmm
paying stocks, or even stocks, and risk it that there could be a drawdown right when your tuition payments come?
Yep.
Probably not. So what you could say is, look, I know the first year's tuition is going to cost X, whether it's 10,000, 20,000, or I need to supplement my kid. They're getting a bunch of financial aid, but I still need to have a couple $1,000.
hmm
Whatever the number is. That's not money you want to risk.
Exactly.
So now you want to put it in fixed income. Now, do you want to put it in your checking account that pays no interest? Or do you want to put it in a mutual fund or an ETF or select your individual bonds?
hmm
You can do that. But that's something that would be ideal for an ultra short duration or a low duration category. But what I mean by barbell is here's some immediate needs. So you've got 4 years of immediate needs for that
hmm
child. So you
hmm
take that's money you reallocate to them. So take this in a broader picture. I know that things happen. COVID happens, '08 happens, the internet bubble blows up, things happen.
Yep.
And who knows where we are in the flow of funds and world and macroeconomic, and there's market strategists, but I don't know. But what I do know is if I'm going to invest long term every year and put money away long term, there's a certain amount of money I need for a rainy day.
Yep.
So what's my burn rate? How much am I spending if I have no money coming in for the next 3 years?
hmm
Well, that's not money I really want to risk. So maybe the first year sits in your bank or 6 months sits in your bank, probably six. The next 6 months, you put it to a year, you put it in an ultra short duration category. And the
Yep.
rest you put in fixed income, but low duration because your horizon's 3, 4, 5 years. It's not longer. You don't want to put it in 10-year bonds because you don't have a 10-year horizon.
Yep.
So now what you do is every 12 months you reassess, you sell a little, you buy, you rebalance. So now what I would say is people can think long term, whether it's long term bonds, because they think rates are going down, or they think it's just a great rate yield to lock into,
hmm
or they want to go buy India, or they want to go buy China, or they want to go buy Japan, or they want to go buy FANG, or they want to buy AI, or they want to buy crypto, or they want to buy US stocks, but they're thinking long term,
Yep.
right? But that first 4 or 5 years, that's not money you want to mess around with. That's what I mean by a balanced approach. And
Yep.
fixed income can be a great way of doing it. Sorry, I
Yeah.
talked too long. I apologize.
Yep. Not at all. I really appreciate that. You have obviously a lot of experience, a lot of insights. Kind of going back to anything can happen. I'm on year 26 of investing myself, and I know you've been in the market much longer than that. We have seen all the things that can happen, and the worst thing that could happen to you is that you are needing money at a certain time, and then you have that huge drawdown right at the beginning. The sequence of returns, risk, and things like that, it could destroy your future, both in your portfolio and your lifestyle. So you really have to consider like when you need the funds, what your objectives are when you invest. And if you only focus on the long term, like you mentioned, you might be putting yourself at a higher risk than you really feel comfortable with or can even manage. So it's really important to really think about the time horizons, what you need the money for, what are you willing to give up if it doesn't happen, if you take an equity and it loses value. So people really need to start focusing on, matching your needs to your investment horizon. I did a video a couple of months back where it's like, your timeline is one of the most important things when it comes to picking your investments. And I think a lot of people make the mistake. They think I'm going to buy the Apples or the Palantirs or, whatever happens to be, and I'm just going to sell it off in the future when I need it. Well, that doesn't always happen. History has shown that doesn't always happen. So,
I mean, it's like life,
mhm,
right? Think about it. College grads today are having a much harder time getting a job than when you and I
yeah,
graduated. And
absolutely.
now, they didn't think that. There was an assumption you just graduate college and you find a job, no problem. Very rarely is it a problem.
Yeah,
Right now, for some people, it's a problem, and it's more complicated because of the technology changes we're seeing.
yep,
And then the question is, what do they do while they're searching, for their career? Do they pivot? So, whether it's investing where you need to match your goals and your horizons, your needs, it's like life. You also have to understand that the world just throws curveballs.
Yeah, it certainly does, both in the macroeconomic world events or just your personal family situation. Things come up all the time. So to be tying all your goals and your ambitions to long-term strategies is something we need to reconsider. And that's, a lot of your strategies focus on that low duration, short time frame, more of a certain thing that you can count on that income coming in without having a ton of the risk, and especially not as much of the equity risk as even something like a dividend stock. I mean, so many people invested in the company United Healthcare, UNH. They thought it was a gold star dividend fund. It's lost 50% of its value this year alone. And so, like, even what you think is a safe company may not be safe for your timeline.
I
It might
think,
be great for the next 10 years, but if you needed the money today and you had to sell off your stock, you're in
well,
trouble right now.
I also think it's really important whether you invest in stocks, dividend stocks,
Hmm.
bonds, uh, or anything, that you understand the fundamental use case and the business proposition. So something like United Healthcare, you have to decide not only the valuations, but you have to understand, what did I think of the business? Simple SWOT analysis, strengths, weaknesses, opportunities, and threats could lead somebody to. I mean, United Healthcare is not a company or industry we would lend to. We wouldn't lend to
Hmm.
Aetna. We wouldn't lend to any of United Healthcare's competitors because we don't like the business dynamic. Like, this is a
Hmm.
basic thing people understand. In those companies, at the end of the day, your payout, what you have to pay out and what you can charge, are very politically dictated by the government,
Yeah.
by Medicare and Medicaid,
Yeah.
right? You can only get away with so much premium gouging before before the government steps in. So these are businesses that have very high regulatory risk,
Yeah.
and you have a user base that's not aligned. If I'm paying X in premium and I break my clavicle in multiple spots and have to get surgery like I did this year mountain biking,
Oh, man.
hey, I'm going to get my colonoscopy this year. I'm going to get
Hmm.
this year. I'm through my deductibles. I'm going all full hilt.
Yep.
So there's an alignment of interest problem with their underlying consumers, who are not the ones that are necessarily paying the healthcare bill. Maybe the company is, or maybe you are. But I think you have to look at those businesses. So United Healthcare had lots of issues that one had to think about, could come in, pardon the phrase, bite you in the ass. So that's not one I would pick necessarily anyway.
Yeah. So I guess with that, in my personal life, I am more comfortable researching and analyzing, equity stocks, dividend stocks. I'm not so strong at picking bond investments or short-term income. So I find that it's a benefit to have an active manager approach to something that I'm not familiar with when it comes to short duration, things like that. So can you kind of explain, like, what you feel like is the added benefit of using an active management strategy compared to a passive one, or trying to do it on your own?
Sure. So first of all, fixed income investing has two complications. It has the fundamental valuation and credit work that needs to be done, that you're so familiar with as being a stock picker.
Yeah.
And then it has bond math,
Mm.
right? And that bond math gets more complicated because something that's really, really good and juicy can be taken away from you, right? Without you really having to say, because rates went down or they
Hmm.
decided to
Hmm.
refinance cheaper. Yet you have all the downside. So, in those environments, um, it really makes sense that, because it's more complicated, that maybe you use somebody who's in the weeds that you trust.
Yeah.
That being said, I would say the same thing about stocks or any investment. If you don't know what you're doing, you need to go and hire somebody. I'm not going to write a will, um, right? I'm not going to write a will if I don't know what I'm doing, unless I have no choice. I need a will, but it's all I can afford.
Yeah.
You know, the other thing is, there's a lot of nuance in fixing them. So one of the things that's
Hmm.
happened is, people hear a lot about leverage loans or bank loans. It's almost a form of direct lending, except that it's syndicated, meaning it
Okay.
trades among lots of different people.
Yeah.
And because so much money poured into this industry, because they were able to create securitized product or asset-based product to allow leverage on leverage on leverage, um, the money was flowing in so much, they started giving away covenants. These are contractual rights to protect the lender from bad acting or just
Mm.
business going south. Like, hey, your business isn't doing well. I want to make you come pay me off or restructure before it gets too bad. Like that might be through a fixed income charge coverage. But those covenants have all gone by the wayside. They existed
Mhm.
in the 80s when I went into the business and the 90s.
Okay.
Because the leverage loan business doesn't. So now they have what they call cov-light businesses. They have covenant-light. Well, that's great, but if you're a really wealthy person, do you want to get married without a prenup, hoping it'll all turn out good? It's the
Yeah.
same analogy.
Yeah.
So an active manager is very needed in that space because the more you take protections away, the more
Mhm.
you need someone who's an expert in the field. Also to manage duration, et cetera.
Yeah.
Um, I'm a big fan of people doing it themselves if they have the capability
Mhm.
and if they understand what they're doing. And if they don't understand what they're doing, then I'm in favor of them allocating out to others, with one exception.
Okay.
You have to understand the underlying asset, period.
Mm.
So, for instance, you should not be buying crypto unless you understand what you're buying and why.
Yeah.
So, if you're buying Bitcoin because you think it's an alternative asset to dollar devaluation
Mhm.
and you understand the risks associated with it, great. That's how you're allocating, like you might to gold.
Mhm.
But if you're saying I'm buying because it's going up, that's not, and your listeners don't typically have that view.
Yeah.
But the one thing I do think people tend to do is I think they tend to focus on one or two asset classes. I'm going to
Mhm.
buy stocks and I'm going to buy X. And I
Yeah.
think it's real going back to think about a puzzle and what are your needs and where are your risk tolerances and how are you putting that puzzle together. And that does require active
Mhm.
management either on your behalf or by hiring someone else.
Yeah, I think it's your ability to do the analyzing and keeping up with it, but also your desire. A lot of people don't have the desire to spend multiple hours a week researching companies or researching funds and things like that. So the outsourcing of that to a active manager is going to save you time to go do things that you want to do with your life. And so that's one benefit.
There's an
So
opportunity cost.
exactly. So even if an active manager costs, let's just say 0.75% more than a passive fund, the amount of work that's going into that active management can either save you a lot of money or make you a lot of money over time
So I,
doing it yourself.
maybe, I'm not sure I agree. I think in the end you have to look at the net outcome.
Okay.
And it's not just the net return, right? There are things that people don't measure, like what was my volatility
Mm,
in order to get the returns. So that can be measured through Ulcer Index, Sorrentino ratio, Sharpe ratio, downside capture versus upside capture. There are many tools to look at it. One of the things that I tell people is we're coming out of COVID. All asset classes have been beaten down. And somebody says, I think high yield is really quite interesting because it's a hybrid between fixed income and equity. It's been beaten down, but
hmm
because it's senior in the capital structure, I can get equity type returns without the same risk. Well, you could hire an active manager to do that. But if you think the corner's been turned,
mm,
quite frankly, you actually might be best off buying a passive because that passive is going to react like that. Whereas
okay.
the active might be reshifting the portfolio. So, in periods where you think there's a robust movement up quickly or a robust movement quickly down, passive fixed income products can actually be very effective. Like if you think the Fed's definitely going to lower rates, I don't want an active manager to decide that for me. Then
hmm
you're being the active manager, and a passive strategy would work.
Yeah.
I
Okay.
will say, in general, the one thing I think people mistake in all fixed income is they don't distinguish between time horizon and maturity.
Okay.
It's really simple. If interest rates go up, prices go down because
Yeah.
you got to be compensated for the new adjustment interest rates.
hmm
If interest rates go down, prices go up. If you have a longer maturity, they go up by a multiple.
hmm
If they have a shorter maturity, they go up by less. And the opposite is true, obviously.
Yeah.
And then there's where you get paid off of treasuries, a spread. It works the same way. And that's now we're into bond pattern. But in my view, if you like equities and you're comfortable with equities, then the only fixed income you should really be looking at are either equity substitutes in fixed income, like high yield or stress securities,
hmm
or short or ultra short duration to give you that time horizon to accept the volatility on your longer term portfolio.
Yeah. That certainly makes a lot of sense. And I think that's even more important as the market keeps going up, as the economy continues to have headlines of potential risk in the future, it's hard to match those two together right now. And so there's a lot of uncertainty in the market. So by having some more chips off the table, if you will, when it comes to equities and into these short duration funds, you might be able to balance out that risk, that you can wait it out, if you will, if you have that short duration type of funds. So, I mean, I guess with that, I know obviously you can't give financial advice specifically, but with all the nuances in the market right now and comparing that to the economic forecast, like where can we go from here? Like what's the most likely outcome in your mind?
Well, I'm going to answer your question, but I want to address one of the things.
Okay.
I was reading the other day. I don't know where. It actually might have been on X. But I do, when I read things, do fact check them on X.
Yeah,
Um,
of course.
and I don't necessarily do it by asking Grok, although that's certainly one way of doing it. But uh, over the last decade, consistently, there's been a drawdown, a significant drawdown, like 20% drawdown and 20% recovery every year.
Hmm.
So you don't no longer have just sort of momentum or flow or cyclical or economic drawdown cycles. You now have just inner year cycles.
Hmm.
And I don't know how comfortable people were in April during the tariff liberation period.
Hmm.
A lot of people joking they were feeling liberated that their net worth just went down.
I know
Now
mine sure did.
we've recovered more than that. Maybe
Hmm.
you feel a little less liberated. But if the advantage of ultra short and short duration fixed income is you don't have to feel like, oh my God, I've got to sell or
Hmm.
be panicked. And you could actually take some of those and say, maybe I want to reallocate or not. All right. So now, and answer your question, look, I don't know. I'm not a market strategist.
Okay.
I'm a bottom up investor. There are certain things, I'm not bad at pattern recognition. Our funds and our strategies did quite well in 22, primarily because the Fed said that rates were going to go up. And I tend to believe, the Fed is the only thing, don't fight the Fed. So using that as a starting point, it's clear that our president would like to see lower interest rates.
Yeah.
We can argue whether we should or shouldn't have lower interest rates. It's a whole different conversation. But it's clear he wants lower interest rates, and it's clear that the treasurer wants lower interest rates
Hmm.
for lots of reasons, including we have a lot of debt we have to finance.
Yeah.
And the treasurer who wanted to finance everything out at the 10-year now is and criticized Janet Yellen on the short-term funding is now saying, well, maybe we should do some short-term funding because rates haven't gone down enough.
Hmm.
So I would say the trend is that rates are likely to go down
Hmm.
on the short end. On the short end, meaning 2 years or less. It's going to take some time because Powell's in place till to May.
Yeah.
But ultimately, I think the trend at the moment is that the bully pulpit is winning that argument.
Hmm.
I think that with that comes dollar devaluation. That's one of the explanations I provide on why gold's done so well, hard assets have done so well, crypto has done so well, because people are looking for a way of protecting dollar devaluation.
Hmm.
So I think those are two macro forces that one can consider. If rates are dropped, I don't know how stimulative that'll be aggregately, because it'll certainly help the housing market.
Yeah.
The question is, will the cost from the tariffs offset some of those savings?
Hmm.
But will it create better employment? I don't know. I mean, Plantair, I don't think really cares about the tariffs, whereas Target cares a lot about the tariffs,
Yeah, for
right?
sure.
But in lower interest rates, Plantair doesn't really care. I think Target cares a lot.
Hmm.
And in dividend-paying stocks, lower interest rates definitely mean that the stocks are more likely to be more valuable
Yeah.
because rates went down.
Hmm.
Um, as far as stagflation, inflation, deflation, look, there's a lot of forces that are going on there. Everybody knows. The question is, how much productivity will we see in technology change? Everyone's talking about AI, but there's also
Hmm.
huge changes in healthcare, in nanotechnology, and quantum computing, et cetera, to the terms we haven't seen since probably the internet days, and these are dramatically more life changing.
Hmm.
This
Agreed.
is like I really do think we're on the turn of like truly more of the revolution, like an industrial revolution, which I think is potentially greater than we have. But it takes a long time.
Yeah.
One of the things we learned from the internet bubble was a lot of capex was spent. It was very successful, and the market reacted positively. And then they found out that maybe too much money really chased too little productivity.
Yeah.
We'll see. I don't know, but that's a huge party that could be both deflationary and increase productivity.
Hmm.
You have those, and then you have this whole American First policy where, there have been periods where this hasn't worked out so well, and then periods where it's worked very well. What
Hmm.
generally happens, though, for people should be aware, is when you first put tariffs on, historically, it is actually stimulative to all economies, right? Because money's coming into the government, and you're getting protectionalism to some form in industry. So the initial stages are always sort of stimulative. That's what history has shown. So I don't know what's going on. I do think the trend is lower rates, at least on the short end.
Yeah.
I think the trend is dollar devaluation, for sure. It's one of the reasons why I like places like the Nordic market.
Hmm.
We have a Nordic fixed income strategy that we think is very attractive. Better quality companies, less leverage, covenants, and higher uh, uh, bond yields than in the U.S. high yield market. But these are high yield. But it's one of the areas I like a lot. But in general, I think that uncertainty creates a lot of volatility, and I've
Yeah.
been a big believer that there's a lot of volatility, and you got to get paid for illiquidity, which I don't think people are focused on,
Hmm.
and term premium. And I think the fact that everyone's pushing into direct lending as a product, not institutionally based, means that they don't really understand the lack of liquidity. I mean, private equity, everybody loved.
Yeah.
Now, a lot of private equity firms say, I can't sell my portfolio at a price that makes sense, so I'm going to do a continuity fund.
Yeah.
It's great for the continuity buyer, but not so great for the original investor. So we'll see.
Yeah.
I know that didn't quite answer your question, but I did give you two key points that I feel strongly about.
Yeah. It definitely helped a lot.
I
It's
do think
always
we'll have
nice.
inflation, by the way. I just don't know how much.
Yeah. Yeah. Exactly. It's nice to, talk through it with, not necessarily that the answer, because no one really knows, but having each incremental insight helps increase your knowledge base. And I know you have.
Actually,
Mhm.
I haven't done the work on this, but one thing I think your listeners should consider, because you're called the dividend stockpile,
Yeah.
is dividends that are paid in static or grow
Hmm.
are based on cash flow that grows. And one of the
Yeah.
things I do think is people should be paying attention. I'm sure you cover this on how much of the cash flow a company generates is being sent in dividends
Yep.
versus supporting the business, and are they over dividending the money? And since corporate profits are at record highs
Hmm.
as a general thumb, and some of that's justified with technology, the question is it sustainable? And things like tariffs, if it works, means it's going to cut corporate profits because they're not going to be able to shift it all to the consumer.
Yeah. So you have to keep that in mind. If your payout ratios are too high on your distributions, and what happens if their profit margin goes down 10% or 15% or whatever the tariff rate is right now. And I know you have a lot of insights and a lot of information on your website, which is CrossingBridgeFunds.com. You do like a quarterly commentary and things like that. You have a blog out there. So if anyone wants to get a little bit more information on David's insights and his thoughts, you definitely reach out there. Well, while you're here, I wanted to talk a little bit about your strategies, if you don't mind, because you talked about all the great things that having a short duration, high income approach gives. But obviously, you have some strategies yourself. So can you talk about what kind of strategies your company focuses on, and maybe some insights that people could to get some information about?
Sure. So we're an investment management firm, and we produce products to meet people's needs.
Hmm.
So Crossing Bridge funds have three products in the ultra short duration category. This category is really meant for people that have a longer hold period than 3 months,
Okay.
but do not necessarily need to hold paper, you know, or may not want to hold the paper longer than a year. So how
Okay.
do I distinguish 3 months to a year? Like,
Mhm.
why segment? Well, 3 months is very simple. If the market has volatility, 3 months gives us time in our products, even though they're ultra short duration, to go from a price you came into to a drawdown to make it
Mhm.
back up so you get your money. We think 3 months is a reasonable time frame. Anything short than 3 months, banks,
Yeah.
money market funds that don't break the buck, et cetera, are probably, historically better measurements of return relative to the risk based on historical experience. More than 3 months, we believe our ultra short duration strategies in our products will produce more return
Mhm.
than some of those more traditional shorter terms.
Okay.
So by definition, if you invest longer, you should make more, right?
Mhm.
You should be compensated to make more. You should get a higher yield in bond terms. Doesn't always happen, but that's what should happen. So, if your idea is I'm gonna invest and I have a 5-year horizon, then why would you take an ultra short duration product?
Yeah.
One of the things I think happens on the opposite is people buy a home and
Mm.
there's no way in their mind they think they're living in that home for 30 years. It's quote my starter home or I might move because of my job. So to get a 30-year mortgage means you're locking in a rate to protect yourself that you can refinance lower
Yeah.
for a period you don't plan to be there. You'd be better off looking at a shorter term structure
Mhm.
if you have certainty. So the same concept applies here. So 3 months minimum. If you start thinking about like a year and a half or longer, I would encourage you to look at longer duration products.
Okay.
But in our ultra short strategy, we think that's a deal. And we have sort of 3 products that focus. One is a high yield product that uses high yield as a cash alternative in a very unique way. Um, uh, and that was the first product we came out with. We had partners named River Park when we did that. And our secret sauce is when companies refinance their debt, they have to give the holder of their debt 30 days notice before they can take them out.
Okay.
So it's like if you had a mortgage, you had to tell the bank you needed 30 days before you took it out. So during that period, there's natural sellers and not natural buyers. Because if you're a life insurance company, you don't want 30-day paper.
Yeah.
We have an investment grade product in that area. So high yield tends to get people nervous. There's an investment grade product. It tends to be a little longer in duration, but still all 1 year or less. So therefore, if you believe rates are going down, it has some of the benefit of participating more in that trial down in rates. And then we have a pre-merger SPAC ETF strategy, which is great because we always have a mandate to sell the SPACs at or above liquidation value and buy them. Sell them above liquidation value and buy them at or below. And there's a forced liquidation date, and then
Mhm.
I get lucky and Donald Trump might have a SPAC or somebody might do a crypto SPAC and you get a pop.
Yeah.
But there aren't that many left, and it's a very small ETF, but it's certainly met that category. Now, let's say you say, "Oh, I don't need money for a year. My kids'
Mhm.
college education." Let's do that example. So, first year, ultra short duration and money markets.
Yep.
Second year, third year, low duration, right? Even 4 year, because you want to earn a little more return,
Mhm.
take a little more more volatility because your time horizon's longer. So if you can pick up return, hopefully,
Yep.
that would make sense. So we have a low duration, high income strategy in there. We have a mixture between high yield and investment grade. It's typically at least less 65% or less high yield. It's typically, got a nice slug of investment grade. Can have 100% investment grade. People should think of it though that it's a little out on the credit risk circle. You have to take risk to make return.
Mhm.
There's no free lunch.
Yeah.
So we're comfortable with bottom up investing and taking credit risk where we're looking at companies that may not. So Xerox, not so much. Other companies, maybe. So um, the duration there is typically in low duration, high income strategies, 3 or less. Ours is more like 2 or less.
Okay.
Again, matching that horizon. More than 3 years, I'm going to invest fixing them for the long term. I'm a retired person. I want an annuity, a certain income of stream, but I want something better than what the insurance companies paying an annuity. You can
Yeah.
take a longer term view because it's about the cash flow coming in. In fact, that's really good for your dividend stockpile,
Mhm.
right? Except you have upside downside volatility. So then you want even a longer duration. And if you're willing to do that, then you want to start looking at things like strategic income strategies and things like that. So that's sort of what our offerings are as products in the strategies that we do.
Yeah.
And
So
they should go to our website if they want to look at the specific funds that do these things. And feel free to email us They can email me, dsherman@crossingbridge.com, or Jay Connor, who's our executive vice president at crossingbridge.com. If they have specific questions on our specific products or strategies, or just general questions, we are very comfortable saying, I don't know.
That's actually a surprising thing, because not everyone will do that. So that's awesome. Yeah, I'll definitely put all your contact information on the video and in the description below, so people definitely go out to their website, reach out to them if you have any questions, check out their strategy, see if it works for you. Feel like you guys have a very unique product that a lot of people should at least consider. So again, that's why I wanted to bring you on and have you explain kind of like your methodology, as well as your mindset when it comes to, the duration, and how you need to pick the duration based on your needs and your risk tolerances and things like that. Definitely reach out, ask questions, research the fund, see if it works for you. We'll definitely reach out if anyone has any questions direct on this video. Make sure we get the answers directly. But as David said, reach out to him or his firm directly. Again, David, appreciate your time, appreciate your insights. We'll talk soon.